12 powerful options strategies every trader should know. Similarly, when we trade in options, we know it involves a certain level of risk, but we still participate in them with the anticipation of a jackpot like the game above. But if you look at advanced options traders, they generally treat options as a hedging instrument or as a strategizing instrument where the goal is to maximize profits while minimizing losses. In reality, there definitely exists some option trading strategies, and these option trading strategies are designed in such a way that limits the risk quotient and opens a portal to unlimited profits. In this blog, we shall discuss 12 such option trading strategies that every trader should be aware of when trading in options. Option trading strategies refer to buying calls or put options or selling calls or put options or both together for the purpose of limiting losses and gaining unlimited profits. Call options give the holder the right but not an obligation to buy the underlying stock, whereas put options give the owner the right, but not the obligation, to sell the underlying stock at a predetermined price by a set expiration time. Option trading strategies can be classified into bullish, bearish or neutral option trading strategies. Presenting to you 12 types of option trading strategies every trader should know and can use to level up the game of their option in the stock market. Everyone loves a bull market, and we see maximum retail participation in the stock market when the indices are flying high, so we start off with bullish options strategies. A bull call spread is one of the bullish options strategies that involve buying one at the money, ATM, call option and selling the out of the money call option. In this strategy, profit is made when the price of the underlying stock increase, which is equal to spread minus net debit, and loss is incurred when the stock price falls, which is equal to the net debit. Net debit is equal to the premium paid for a lower strike minus the premium received for a higher strike. Bull call spread helps in protecting when the prices fall, and the profit amount is also limited. This strategy is a great alternative to just buying a call option when the traders are not aggressively bullish on a stock. Bull put spread is one of the bullish options strategies that options traders can implement when they are a little bullish on the underlying assets movement. This strategy is similar to the bull call spread, in which instead of buying calls we buy puts. This strategy involves buying one OTM put option and selling one ITM put option. A bull put spread is formed for a net credit or net amount received, and it incurs profit from a rising stock price that is limited to the net credit received. On the other hand, the potential loss is limited and occurs when the price of the stock falls below the strike price of the long put. The call ratio back spread is one of the simplest options strategies, and this strategy is implemented when one is very bullish on a stock or index. This strategy is a three-leg strategy that consists of buying two OTM call options and selling one ITM call option. A synthetic call is one of the bullish options strategies used by those traders who have a bullish view of the stock for the long term but are also worried about the downside risks at the same time. This strategy offers unlimited potential profits with limited risk. The strategy involves buying put options of the stock that we are holding and on which we have a bullish view. If the price of the underlying rises, then we shall make profits, whereas if the price falls, then the loss will be limited to the premium that is paid for the put option. From the above payoff diagram, we can see the risk is limited to the premium, whereas the potential profit is unlimited. When you see people flying high during a bullish market, there is always a lot looking at bearish option trading strategies. So, let's take the discussion further and look at bearish option strategies. The bear call spread is one of the two-leg bearish options strategies that is implemented by the options traders with a moderately bearish view on the market. A bear call spread is formed for the net credit, and profits are made from this strategy when the stock prices fall. The potential profit is limited to the net credit and potential loss is limited to the spread minus net credit. From the above PL diagram, we can see that this strategy involves limited gains which are equal to the net credit, and loss is limited, which is equal to the spread minus the net credit. This strategy is quite similar to the bull call spread and also quite easy to implement. Bear put spread strategy involves buying the ITM put option and selling the OTM put option. This strategy is formed for a net debit or net cost and profits as the underlying stock falls in price. From the above diagram, we can say that the profit is limited and equal to the spread minus the net debit and the loss is equal to net debit. A strip is one of the bearish to neutral options strategies that involve buying one ATM call and two ATM puts. One should note that these options should be bought on the same underlying, and also with the same strike price and same expiry date. As we can see from the above example, the maximum profit is unlimited and the total loss associated with this strategy is limited to the net premium paid. Long strangle involves buying one OTM put and one OTM call option. Here, the profit is unlimited and the maximum loss is equal to the net premium flow. The maximum profit is incurred when the underlying asset closes between the middle strike prices at expiration.